Good evening, one and all. Fable Trading presents Climatic Behavior. How to identify and trade parabolic movement. And this is part of our individual strategy series. And before we begin, please take a read through the disclaimer and copyright. Please don't share on any torrents or any file web sharing sites, etc. Today's agenda. We have a lot to get through as climatic behavior is quite a complex study. So we shall begin today with a foreword and then an introduction. And then we'll go through the anatomy of climatic behavior. Four major characteristics. We talk about market shakeouts briefly and labeling as so. And the nature of a climactic bar. What essentially does the climactic bar in question achieve? What's its purpose? And then we talk about climactic classifications. There is some additional info we must go through. And then we come to the all-important process. And this should be very helpful, is where we break down climactic action through a series of thoughts and process to help us try and actually identify the bar to be climactic. And then the bulk of today's session, our studies, we have bearish studies, bullish studies. We then end with some quizzes and then some final words where we can wrap up and go through any questions and answers that may arise. I will answer each and every question at the end of the study before we move on. Good. So let's begin. For those who have knowledge or experience with Wyckoff or VCA will be familiar with climactic bars, as this is the first signal that either A, accumulation, or B, distribution is being formed. And today, and for our setups, we are not using the classic Wyckoff phases of distribution and accumulation. We do study these, and they are covered in great detail via LPA, Logical Price Action, the complete course. Today's session, via this course, we are learning, I don't want to use the word practical, but more of a hands-on approach. We can make plays and initiate a trade fairly quick. We're not looking or trading accumulation or distribution phases. We are looking for climactic bars, and we must be able to identify climactic behavior, and then by analyzing price, we can either A, we can take a position fairly quick, or B, we gain valuable data for context. They give us our background conditions, and this going forward gives us a license to be either a buyer or a seller. So just to reiterate, we're not dealing with classic Wyckoff-ian accumulation or distribution phases that begin with climactic bars. So in a sense, we're looking for single serving entities that are climactic bars that do not provide further characteristics of the accumulation or distribution phases thereafter. Okay, just need to make this point very clear so we're all on the same page going forward. First and foremost, I would just like to say thank you and welcome. I appreciate the purchase. And for today and our time together, we will discuss climactic behavior, its classifications, and how to trade climactic bars for both bullish and bearish conditions, primarily within an intraday environment. And for the most part, we use the 5-minute chart, as this is my day-to-day go-to time frame that I've been using for years, literally day in, day out. Now, the 3-minute chart is also very effective. But as a general rule, from my limited experience of working with, each and every time frame, the setups work very well from a 30-second time frame up to, say, a 7-minute time frame. I mean, this, of course, is not set in stone. I haven't tried to trade on every time frame. But saying that, any time frame above 10 or 15 minutes, things start to change. The way price moves and structure forms differs, and it does so in a big way. I mean, the principles still apply across all time frames, as in the theory and the way that we can read the market, the climactic behavior, the bars, etc. Yet the way to trade climactic bars is different. The way price unfolds and comes back to test the climactic bar is far from an intraday environment. Although I wholeheartedly believe that the markets are fractal in nature, this is one of those little caveats, one of those exceptions to the rule. First, we need to establish what is a climax. What is a climactic bar? And in simple terms, it is a widespread bar, much wider than the previous bars, with ultra high volume, and can often appear to suddenly pop out of nowhere and go straight up or down. Alternatively, we can have 2, 3 or 4 bars that gather pace with good momentum and price prints almost vertically. That is a telltale sign, as the market cannot sustain this level of buying or selling. It's exhausting itself. And the term one can use is that price is parabolic. Just to make sure we're all on the same page before we go into any forms of study, let me draw this for you so we have a visual representation. This is volume and this is price, and this will be our volume for standardized volume, and say we come up, we come down, we come up, then all of a sudden bang, we have printed a huge widespread bar like this with volume like this. As we can see, this spread is much larger than all of these spreads over here, and this volume is much higher than all of this volume to the left. So therefore we would label this bar climactic. Okay? Please bear in mind we're not taking into consideration any other factors, no context, no structure. But this bar, for all intents and purposes, pops out of nowhere. And alternatively, we can have 2, 3 or 4 bars that gather pace with good momentum and price prints almost vertically. And if you're experienced in the markets, I'm sure you've seen this many, many times. Could be trending higher, like so. Normal trend. Then all of a sudden, let me just draw bars. Down, up, down, up. And then all of a sudden we could print a bar like this, like this, like this, and like this. And we can see the spreads increase, and then we have all this volume, say like so, all along, and then volume suddenly surges like so with the spreads. And this action here is a telltale sign that the market is exhausting itself. Okay, so the spreads increase and the volume increases dramatically. Therefore, this action we would also classify as climactic conditions. Very simple. Again, we're not taking into consideration any forms of structure or context. Okay? Here is a very simple chart to illustrate, for all intents and purposes, climactic bars. We're looking for widespread bars and very high volume. But like I keep on saying, at this moment in time, we're not taking into consideration any other factor at present. Zero context. We're simply looking for the obvious, and these bars stick out like a sore thumb. So what can we see on this chart? Here, here, and here. Look at this spread here, this volume. Okay, we have no context, but we can see these 3 bars here, these spreads. This bar we would label as climactic. This bar, huge surge in volume over all of this price action to the left, and again look at the spread, very wide spread. And then here, very wide spread with even higher volume, the highest volume on the chart. So these bars A, B and C are all climactic. We would label these as climactic. Okay? Nothing to it. Good. But trading, as we all know, is far from perfect, and labeling climactic bars can be tricky at times, as we will discover shortly. However, there are a few characteristics of climactic bars or behavior, or so-called action, that helps us to identify and label the bar as indeed climactic. First, we must familiarize ourselves with the thought processes and concepts before we begin our studies. No follow through in the direction of the climactic bar. If we drive up with a wide spread, like so, and high volume, naturally one would expect higher prices. Now, if there's no follow through, alarm bells should be ringing. I mean, that's not to say we can't penetrate the highs of the climactic bar a little and flounder around with very narrow spreads, or perhaps a little volatility with some wider spreads. However, you must pay close attention to the closes of the bars. They must be near the climactic bar. We need to see evidence of the sellers pressing the market for this bullish example. So this is our bar here. What do I mean? Well, if this bar was indeed climactic, we don't want to see any of this to the upside. Okay, there wouldn't be any follow through from the highs of B. Let me just draw B over here. So this is B over here, and we draw level of resistance from its highs. If we had a little penetration with small narrow bars, and they come back down, and they come around, and they come back down, we would still say that there is no upside follow through from this strength we see. If we see a widespread up bar with good volume, we would naturally expect higher prices. That is only natural. If we don't see any follow through, like here, alarm bells should be ringing. Alternatively, if this is our bar B here, and this is our level of resistance from the highs, you can get huge bars like so, and like so, like so, but they will all close back around the same level. So these bars, again, although they've made higher prices, we can see that sellers come in. Buyers drive it up to the highs, bang, sellers come in, closes back under. Buyers drive it back up, bang, sellers come in. So the sellers on these bars are having an effect. Although they're making higher prices here, they are capping upside progress, and we are closing all in the area of the climactic bar. Okay, again, this is no follow through in the direction of the climactic bar. Because we're trending higher and we print a strong up bar with high volume, we would expect higher prices. We see this kind of action, or narrow spreads coming up and then coming down, there is no follow through. Alarm bells should be ringing. Good. Another sign of climactic behavior, which occurs frequently, is the climactic bar printing towards the end of an established trend, especially, pay attention, if it's within trend channels. And when this occurs, the setup is different, as we usually come back to test in some form or another. So although climactic, the nature of the bar from its spawning ground is different. Because as we trend up or down, price gathers momentum from eager participants looking to jump in. They want to get in on the action. And naturally, this produces a large spread with very high volume. And the close illustrates the opposing force entering the market. Whereas our other form of climactic bars appear to suddenly pop out of nowhere. Ergo, the climactic action between the two is different, and the thought process and how the bar comes into fruition is very different, which we will discuss shortly. Now, I know I'm jumping in deep here, you may be lost, but we go through many examples. Okay, but I just need to lay the theory. I need to lay the groundwork before we move forward. Leading on to our next point. Ideally, we want to see a resolution of the climactic bar in the opposite direction as soon as possible. So the less bars and time that passes, the better. If the climactic bar is bearish and closes weak, we want to see a close above the highs. And if bullish, we want to see a break of the lows and close under. And this action is important as we disconfirm the presence of the supposed strength or weakness portrayed by the climactic bar. And this may offer immediate trading opportunities, which we will go through today. Let me just draw this very simply. This is a down bar closing weak. This would be our climactic bar. We want to see a resolution above the highs. We could do this in 1 bar like so, or 2 bars like so, or 3 or 4 bars. We want to see the less bars and time that passes, the better. Because this climactic bar is perceived weakness. So we're coming down with these narrow bars and all of a sudden we get this huge down bar. Massive volume. This is the volume for these bars coming down here. Okay, so we're thinking, okay, we got lower prices on the cards. And if we eradicate this portrayed weakness in 1 bar or 2 bars or 4 bars fairly swiftly, we disconfirm the weakness or portrayed weakness via this bar. And this may offer immediate trading opportunities. And like I said, we do have examples we will go through today. And another tool of analysis or thought process with climactic bars is to ask yourself, now, what does the bar achieve? As in the effort it takes to produce, and don't forget that effort is measured in volume and climactic bars have high volume. Is there anything of significance to note? i.e., are we breaking structure? Are we breaking support, resistance, trend channels, any other pattern formation? So if not, then odds dramatically increase that the bar is indeed climactic. Think about this logically. There is no need for the market to produce an ultra widespread high volume bar if it's not achieving anything. Therefore, it's an anomaly and would be labelled suspect behaviour. And here's a little study to cement this concept. Price all around here is average. Narrow spread, average, average. Average volume, low volume, low volume, low volume. Then boom, all of a sudden, bar A prints. Huge volume, much higher than all of this action to the left. And look at the spread. 3, 4, 5 times the size of these bars. And this bar here pops out of nowhere. Now ask yourself, what does bar A achieve? Nothing. It really doesn't. It doesn't even test the swing high here. We can't test this little level of resistance here, and we can't test this resistance here. We're not breaking any structure. I mean, there is no trend to speak of. Therefore, this bar, bar A, our climactic bar, is an anomaly and suspect. And for those interested, we do come back to this study a little later. We just need to establish our foundations before we go into our full studies. We need to clear up all the theory. Before we go any further, for those familiar with Wyckoff and VSA, there is a bar known as a shakeout, and the very name suggests its action. It literally shakes the market before high prices are made. It will print a wider spread and higher volume than most bars locally. And more often than not, there will be a quick resolution, as in price will erase all the negativity swiftly within a few bars. And the intention behind the shakeout is to get rid of weak longs before markup, as in higher prices. And this action has very similar characteristics to that of a climactic bar, yet are different. As shakeouts often occur towards the end of trading ranges and in the beginning of trends, whereas climactic bars, or for this course, often occur towards the end of trend channels and they pop out of the blue, out of nowhere. So the nature of a shakeout is to get rid of weak longs. It scares weak traders to cover who have positioned themselves correctly, where a climactic bar is wrong footing the market. Very different behaviors. And of course, the biggest difference is the nature of the setup. Its very essence. Climactic bars are reversal plays and shakeouts are continuation trades. For example, here we have the ES Mini on a 5-minute time frame. Yes, bar A here is climactic, widespread, high volume, but our focus is on bar B. This is a shakeout. And if we add a little structure, all becomes clear. Price, as we can see, is contained within a trading range. And we have been here, say, for 3 hours or so. Then boom, look what happens. B breaks down to reverse and close back above support with a clear surge in volume. So this action achieves two things. One, weak holders may sell as we break support, as they're thinking lower prices. Because at some point, don't forget, this bar, the close would be on its lows and it would look like this. And this is very negative. And if you're long from here, or you're buying up here, your stop would naturally be under support. Agreed? So when this breaks or breaks down like this, this is a very scary bar. And weak holders would cover this bar as they're thinking lower prices. And two, resting sell orders get triggered from other types of traders, support and resistance traders, etc. So as price dries back above here, these traders are trapped. And as you can see, we never look back. And this action is a classic shakeout. And they usually occur towards the end of a trading range or the beginning of new trends. Now our purpose, or our primary purpose, is not to study shakeouts. Albeit I have shared an example for clarification reasons. Just to reiterate, we have a trading range here, boom, 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 that's lasted, 3 hours. We print bar B, drives down, weak holders short, induces some kind of trap, we reverse to close back above support with a surge in volume, and we never look back. And this is a classic shakeout. You'll see this time and time and time again. It gets rid of weak longs or induces a trap. And as these trapped traders who are selling under here, this adds more fuel as they start to cover, as they can't hold onto the pain any longer. Going forward, we can classify the shakeout as a form of climactic action. It's very hard to pinpoint and give concrete rules for a climactic bar. However, in general, from the markets I trade and my experience, it will have, say, 5-6 times the average volume as a minimum, or 4 or 5 times the average spread. Whereas shakeouts, on the other hand, are not as aggressive. So they may have 2 or 3 times the average volume and 3 times the average spread. I mean, that's not to say the market can't print or produce larger shakeout bars, for sure. I've seen them and traded them. But in general, they are within those parameters I've given. As for climactic bars, I mean, there is no room for interpretation, and they do stick out like a sore thumb, and this will become apparent as we go through today's course. Before we move on, I must clarify that the term shakeout is primarily used for bullish environments, as it will shake down, then resolve to continue north, as we can see here. Shakes down and we continue north. For some reason, there is no term for a bearish shakeout. So going forward, we will just aptly name this bar as an upside shakeout. For example, if we're coming down like so, and we have a little trading range here, we could pop up, come down like so, and then continue south. And this we can label as an upside shakeout. Nothing complicated. So for further understanding or a detailed analysis into shakeouts, we discuss this topic in depth via LPA, Logical Price Action, the complete course, with various case studies covering both ordinary and terminal shakeouts. However, for this course, the finer details are not necessary. I have shared what's of value for this particular strategy, and I just need to make you aware that yes, this is a climatic bar because it has widespread and high volume in all the bars, but because of context, as in we're within a trading range and the beginning of a new trend, this is not our form of climatic bar we are looking for. This we label as a shakeout, and we need to know the difference. We have covered the nature of a shakeout, where the market eradicates weak longs for those traders who have positioned themselves correctly and get spooked out by the sudden down bar and then cover. So now the question remains, what is the nature of a climatic bar? What's its purpose? Well, in essence, it wrong-foots the market and traps traders. A climatic bar that pops out of nowhere, literally materializes out of the blue, can break a piece of structure, support or resistance, and take all the stops that are resting and induce some sort of trap. And if we break an area of structure with a widespread and huge surge in volume, we would associate this as a valid break. However, if there is no follow through in the direction of the break, which we have just covered, and we resolved the perceived strength or weakness fairly quickly, we can label this bar as climactic, and if the conditions and the context are correct, we can initiate a trade. Let me draw this quickly for visualization purposes. This is, say, resistance, and if we have a widespread with good volume, and this is all the bars before with this kind of volume, if we break like so with good volume and good price action, we would associate this as a valid break and we would expect higher prices. However, if we print this bar and then we get no follow through and then we start trading back under, we eradicate this perceived strength from this bar. Okay, so if we start to close under this bar, we wouldn't call a breakout bar, we'd call this a climactic bar, and this wrong foots the market. Why? Well, because we have resistance. We break with a widespread and high volume. We expect higher prices. No follow through. We come back to reverse and we start trading under this bar. So this bar is not a breakout bar. When we trade under it, we can say that this bar is climactic. And therefore our mindset changes. Now we're looking for trading opportunities. Okay, so due to context, we can initiate a trade. So now we can label this bar as indeed climactic, where when we first break like so, it's a breakout bar. But again, no follow through. We start trading back under this level of resistance or the lows here. We can label as climactic. And this changes the game. Good. So as mentioned earlier, climactic bars can also print towards the end of a trend. Now this action is of major interest. Our ears must perk up, as this is the basis, the premise, the ignition, the starting point for many of our trades, and high odds trades at that. For example, say we're in an uptrend and towards the end we print a bar with very high volume and a wide spread that closes towards the middle or the lows, and this tells us that selling is present. This action traps a lot of momentum traders and FOMO traders, fear of missing out, as they all want to join in the action. Think mild hysteria. We have been trending up. They are missing the move. So as the FOMO and momentum traders buy, the smart traders are selling into their buying. They're offloading their positions. They're locking in profits for the ones who've bought down at the beginning of the trend, and they re-establish on occasion a short position. All of this action is activity, and activity is measured by volume. Hence we have ultra high volume and a wide spread. And due to the nature of this form of climactic behavior, setups are not instant like the climactic bars that suddenly materialize out of the blue. So more often than not, the market will come back down to test the high, low, or close of said climactic bar. Don't worry, we will go through various case studies explaining these core concepts. And if you think deep about this setup is a reversal play. It's a counter trend trade. It's a market turn. In effect, it acts like a V spike reversal at times. I mean, we never know how much the market will give, but we must take into consideration the nature of the play. Although we have many examples, let me briefly draw this for you. So we have a trend channel like so. And we come up, say all bars are like this, all the way up. So we're trending higher. So this could have lasted 3-4 hours on our 5-minute time frame. So this is average spread and this is average volume. Just say average for this move. Then all of a sudden we print a huge widespread up bar like this, and it closes like so with this kind of volume. This would be our climactic bar. Huge volume. 5, 6 times, 4 times, whatever. Much higher volume. Huge spread compared to the previous spreads. And this is a trend channel. So this bar, we would be overbought. We close near the lows. This is telling us that selling is in the market, because this took a lot of effort. We drive up into brand new highs, breaking through this piece of structure, the supply line, and then sellers slam it back down. And all the while here, you've got all the momentum traders, then you've got the fear of missing out, the FOMO traders. So as we break through here and we break into new highs, everyone gets a bit of mild hysteria. We're taking off, we're going to keep on carrying higher and higher. But the smart traders, they sell into this buying, who have positioned themselves correctly down here at the beginning of the trend, here or here. So they're taking profit, and they're also establishing themselves by taking a new position. Then from the highs here, we should have some form of reaction. If you look at this here, this setup is a reversal play. It's a counter trend trade. It's a market turn in effect. And it acts kind of like a V spike reversal. It certainly does at times. And we never know how much the market will give. But we must take into consideration the nature of the play. We would not expect a true change of trend, as we need to build cores through a trading range in the form of accumulation or distribution. And of course, we must take into consideration the higher time frames. But saying that, when the time frames are aligned, on occasion one can obtain position at the very beginning of a 60-minute time frame trend via the 5-minute chart. Even though we look to higher time frames for general direction, for further price movement, it's on the 5-minute time frame where the market turns first, and on occasion that turn can happen like so. An important habit to form in one's introduction to climactic bars, after it has been labelled as so, is to apply horizontal lines from the close, high and low, and think of them as support and resistance levels. And these are crucial areas, very important areas, that the market will respect in one form or another. And the majority of the time, they will offer trading opportunities. It's very hard to give concrete percentages, but way over 50%, perhaps mid 70s or early 80s, a trading opportunity will present itself. Say this is our climactic bar. We simply draw a horizontal line from the low, horizontal line from the high, and a horizontal line from the close. Now, I don't need to do this as I'm familiar and know to watch these key levels, but it may be of benefit to draw these lines in the beginning. And one final thing, if the high and the close are close to each other, like here, we could draw this level in here, and this will act as a zone. Okay. Alternatively, say this is the low, this is the low, and this is the close. And if they're close to each other, this will often act as a zone, an area. Okay. And this is an area where the market can test, and it's uncanny how often the market can literally just touch and bounce off these areas if the low and close or the high and close are very close to each other. Climactic behavior is very much a contextual play, and we must be aware of market events like the US Open, the close, data releases, earning reports for stocks, etc., as these can often provide climactic bars, volatility spikes. And these would always be labeled as climactic bars that appear unexpectedly out of the blue. So just bear that in mind. We must be very mindful around events. I mean, although these bars display climactic characteristics, it's very rare that we trade the US Open or the US close. Well, perhaps we may trade the US Open if contextually correct. However, we'll never trade the close. Data releases, yes, we can make plays. Just be aware of market events that may produce volatility spikes, which look like climactic bars. Well, they are climactic bars. So here we have a crucial piece of information that increases the odds of climactic behavior dramatically, and this is something to keep an eye on. Ordinarily, standard volume characteristics for a standard day's trading on a 5-minute time frame, we print a smile, like so. It will have some kind of U shape. Volume will be high at the open, declines to lowest at lunch, and increases towards the close. This is the open volume. We come down like this. So this is, say, lunch. Volume deteriorates. Then people get back from lunch here, and we start trading for the afternoon session, and volume increases. So this is our volume characteristics, and it's a U shape, or a smile, some people like to say. Now, here's the caveat. If we print a bar during the day that has a wider spread or higher volume bar than the US Open, so this is our US Open bar, and we print a bar with this volume during lunch, this is a price action aberration. And the odds increase dramatically that this is indeed some form of climactic behavior. I mean, we still need to use context. We apply our rules and guidelines and ask the questions in our mind's eye. Are we oversold or overbought in a channel from price? Is there follow through, etc. But more often than not, when we print a bar like this, which is higher than the US Open, something's wrong. And climactic bars also serve us not just in the sense for a direct or immediate position, a setup, but something of equal importance. It offers context via the background conditions. It gives us, or what I like to say, a license to be either a buyer or a seller. And that is half the battle. It gives us direction. For example, if we have bearish climactic action to the left of the chart during the Asian or European session, and then price eradicates the negativity to reverse, and we start trading above the high of that bearish climactic bar, we class this as strength and therefore want to be a buyer. So even though the climactic bar may not offer a trading opportunity, it still offers a great deal of value as it offers superb context, market conditions. I do apologise. There is a great deal of theory that we must get through before we start putting all our newfound knowledge into action. A swell in volume often dictates a change in trend, especially if the market is in an overbought or oversold condition or in an established trend. And this action will often start with a climactic bar, and we must pay close attention, for we may catch the beginning of a new trend. Alternatively, price accelerates and one can apply various simple demand or supply lines illustrating this fact, usually 3 or 4 advances, and this is a good sign of exhaustion and or climactic behavior. Previously we have spoken about the bars individually accelerating like so, and we said the market can't sustain this level of buying and volume is increasing, it's parabolic. This time we're talking about the demand or supply lines. Say we're coming up, this would be our level of support, then this would be our level of support, then this would be our level of support, then perhaps this could be our level of support. So look, price is bouncing here like so, adhering nicely, then boom, we suddenly bounce on this, then boom, price respects here. As you can see, the angle of ascent is becoming higher and higher, and this level of buying is unsustainable, and this is a good telltale sign of exhaustion and or climactic behavior. And a swell in volume often dictates a change of trend, especially if the market is in an overbought or oversold condition. So we're up here, we're trending higher, move like so, and then boom, we get a climactic bar and a few bars like so with very high volume, and all this action here has this kind of volume. This is a swell in volume, and we're overbought in this channel. So all this volume in this swell is the turning point. It's the transference from buyers to sellers, or sellers to buyers if we're coming down like so, and then we have a surge in volume with wide spreads at the lows of a trend channel, a downside trend channel. So all of this action is activity, and activity is measured in volume, and price will appear to stagnate. It will hold a mini trading range. So we're coming up here and we have all these bars. We won't go anywhere. We're not making higher highs or lower highs from here. Price kind of holds a mini trading range with very high volume, or a swell in volume. And let me just repeat this. All the volume from the swell is the turning point. It's the transference from buyers to sellers or sellers to buyers. And all of this action is activity. And activity is measured in volume. And price will appear to stagnate and will hold a mini trading range. Now, this is an advanced concept that we discuss in depth via LPA. I felt compelled to share as it does provide an edge, and one gets a heads up for potential change in trend. And of course, this is valuable intel. But, and it is a but, we still need to see some form of climactic action in this price action, in this swell in volume. Yes, the swell hints towards a potential reversal. However, for these strategies and this course, we are trading climactic bars, not other forms of reversal plays. Suffice to say, climactic setups are definitely more complex than springs and upthrusts, for example, and they certainly require a much higher level of discretion than the feathers weight play, which is very mechanical, very rule based. But after all said and done, climactic strategies are well worth the effort, as these plays literally occur daily and can offer very nice risk reward if you think in those terms. It's another powerful tool to add to one's trading playbook. It's a different kind of skill set that enables the trader to tackle different market conditions. And of course, this is invaluable. I'm sure you'll be glad to hear concludes the majority of our theory. We now go on to the process where we kind of summarize and we have a tick list for all what we have just covered.